Welcome to everybody joining. This is Taxation University, our first class. We'll get started here at about 12:01. We're going to let some people filter in. Thank you to all for joining. This is Taxation University. We're going to get started here in a few minutes, just to let everybody filter in. Thanks for joining again. All right, we're going to go ahead and get started. So hello, everybody. My name is Tyler Parks, and I am the Government Affairs Associate here at the Tax Foundation. Welcome to the first of 3 sessions of Tax Foundation University. We are excited to host TFU, a 3-week educational program explaining the essentials of the federal, individual, and corporate income tax codes. Our lessons are designed to explain how the tax code collects revenue and its impact on the economy. Within each lesson are case studies of common federal tax issues, complete with an explanation of the policy and economics at play. Today, you will hear from 3 Tax Foundation experts, Erica York, Garrett Watson, and Daniel Bunn on the corporate and international tax code. We will break down the corporate tax rate and base and explain how businesses react to the code. After, we will address some common questions and explore the economic impacts of proposals considered in Congress, such as the minimum book tax and canceling amortization of R&D investments. Next, Daniel will offer a high-level overview of the international tax code, focusing on the provisions known as GILTI, FDII, and BEAT. To finish, Daniel will explain the tax deal currently being negotiated at the OECD and its implications for the US government and taxpayers. We will answer questions at the end of the presentation, so please send them in via the Q&A function at the bottom of the Zoom window. Please feel free to send them in at any time during our presentation. As a reminder, this presentation is being recorded and will be publicly available on our website along with the slide deck. Now, I will hand things off to Garrett to get us going. Garrett, take it from here.
Thanks, Tyler. And thanks everyone for joining us for this discussion today, focusing on corporate and international tax policy. And we're going to kick it off by chatting a little bit about the corporate income tax more broadly in the US, give you a little bit of context on its history and the tax rate specifically before moving to the tax base and a discussion about some policy implications. So to start with the big picture, the federal corporate income tax is levied on C corporations, and that contrasts with other business structures in the United States known as pass-through firms. Those firms from a tax situation only face tax at the level of individual owners. By contrast with C corporations, the corporate income tax is levied at the firm level, and that's prior and in addition to shareholders paying taxes on the income they receive from corporations in the form of dividends or capital gains on appreciated corporate equities when they realize the value of those gains. Right now in the United States, corporations face a federal statutory tax rate of 21%. And with additional state statutory rates, that comes out to an average combined rate of about 25.7%. The TCJA, the Tax Cuts and Jobs Act, had brought the US statutory corporate tax rate down from a combined rate of 38.9% in 2017, which at the time, as you can see in this chart, was the highest in the OECD, down to that 25.7% mark in 2021, which is currently slightly above the current OECD average of 22.7%. Now, prior to the TCJA, this relatively high US corporate tax rate reduced US competitiveness and tend to encourage corporations to shift profits abroad, or even in some cases invert, meaning moving their headquarters to a foreign jurisdiction to avoid US tax liability. And so lowering the corporate rate to 21% brought the US closer to the OECD average. It also reduced that incentive for corporations to invert or shift profits, while also increasing investment incentives. A big part of the motivating idea behind lowering the corporate rate is that it would lead to a higher growth rate. And that's partly because the economic literature shows that corporate income taxes are typically more harmful for raising revenue in terms of economic growth, as capital investment tends to be sensitive to corporate taxation. So the corporate income tax raises the pre-tax return that firms need to pursue investment opportunities, which tends to reduce the number of investments that are worthwhile for firms to pursue. That then leads to lower long-run economic output, lower wages, and lower living standards. Another final point to consider is that prior to the TCJA, the corporate tax rate combined with additional taxes on shareholders meant that C corporations were often encouraged to reorganize into pass-through entities to avoid that relatively high effective tax rate, because pass-throughs are only subject to one layer of tax at the individual level. So from the 1980s through 2017, the number of C corporations had decreased, while the number of pass-through firms had greatly increased. So getting the relative tax rate between corporations and pass-through firms is a pretty important part of the policy consideration for the corporate tax rate. So with all of that bigger picture information in mind, I want to turn it over to my colleague Erica to chat a little bit about the corporate tax base, what we're taxing when we think about this rate, and some policy implications.
Thanks, Garrett. So while the statutory corporate tax rate gets a lot of attention, the tax base is just as important, if not more important, than that headline rate. And that's because how the tax base is defined dramatically affects the taxable income that faces the statutory tax rate. So in the case of a business, when we're thinking about a C corporation, the real world definition of profit or income is revenue less the cost of earning revenue, or essentially matching up the definition of income with the cash flow of a business. But some policymakers and economists believe that the federal government should tax businesses on their change in net worth as opposed to their cash flow. The tax base that we have today is really a combination or a hybrid of the two schools of thought. We have some features of the tax code that move towards taxing businesses on their cash flow, and we have other features of the tax code that move towards taxing businesses on their change in net worth. Now, this definition becomes very important because the distinction of what a normal tax base is used to classify what counts as a tax expenditure. The Joint Committee on Taxation generally uses the change in net worth definition to determine what's normal, though they do make a few exceptions. So the official definition in the tax code or the tax law of a tax expenditure is a revenue loss that's attributable to provisions of federal tax laws, which allow a special exclusion, exemption, or deduction from gross income, or which provide a special credit, a preferential rate of tax, or a deferral of tax liability. So to put that in simple terms, you can kind of think of most tax expenditures as spending programs or subsidies that are administered through the tax code instead of through the normal appropriations process. But because of the definition that JCT uses of a normal tax code, some provisions that are classified as expenditures are actually important structural elements to define the tax as falling on cash flow. But since cash flow isn't the normal definition, they're classified as expenditures. One of the biggest examples of this is accelerated depreciation or rules for capital cost recovery. We can go to the next slide. So how capital assets are accounted for in the tax code, and capital assets would be things like when a business purchases machinery and equipment or builds a new factory or warehouse, how the tax code treats that dramatically affects what's defined as taxable income, and thereby it influences the cost of capital. So the higher the cost of capital, the less capital is formed and the less economic growth the economy produces. The chart on this slide here illustrates how any cost recovery system that falls short of allowing full and immediate deduction for capital assets creates a drag on growth because it overstates the business's profits and artificially raises their taxes. Now, our current tax system does this. It understates business costs for physical capital purchases because it requires them to be deducted over time according to schedules set out in the Modified Accelerated Cost Recovery System, or MACRS. In contrast to depreciation, cash flow expensing, or immediately recognizing the amount of money that a business spends on an investment, is the preferred approach of business economists. For example, if you opened up a finance textbook that an MBA student is learning from, it would instruct that student to use expensing in the investment planning process to determine if that project that they're thinking about doing is economically viable or not. And that's because expensing will fully reflect the cost of the asset that's being acquired. And when expensing is allowed in the tax system, it results in a system that has a minimal distortion on decisions to invest. So it's an economically optimal system. Depreciation, on the other hand, tends to be referred by the accounting profession. It tends to be preferred by those who prefer that the tax system play a large role in redistributing income. And it's also used for financial reporting. So when a business makes financial statements for their investors, they tend to use depreciation rather than expensing. But the issue is that depreciation doesn't fully reflect the cost of an asset. So it results in a tax system that discourages capital formation. And that's because the big difference between expensing and depreciation is how they approach opportunity cost and the time value of money. So depreciation has this view that $1 today and $1 10 years from now are worth the same. But we know that's not the case, both because of inflation and the time value of money. For example, if I'm a business owner and I spend $100 on a widget today, I can't spend that same $100 on something else because it's already tied up in the value of that widget. And 10 years from now, if I need to replace what I purchased, it's going to cost a lot more than the $100 that it cost me today. The cash flow or expensing approach recognizes all of those concepts, whereas depreciation doesn't. We can go to the next slide. Today's tax code defines 9 different asset classes, and they range from a recovery period of 3 years up to 39 years. Every time a new asset is created, a recent example would be the creation of ethanol equipment. It's up to the IRS to determine which schedule to place that asset into. So in the process, the IRS will try to place an asset within a class that matches its useful life. For example, if a farmer buys a combine and uses it 7 years before it breaks down, the IRS would probably place it in the 7-year asset category, where all agricultural machinery and equipment falls. But the issue with this is that not all assets are the same, even within the same category. So here's some examples. A combine is very different from a tractor. A computer is not the same as a copier. Carpet isn't the same as a furniture, and desks aren't the same thing as a safe. But in each of those pairs, they're assigned the same recovery period within our tax system. The useful life of an asset can vary on a number of factors, like who made it, who's operating it, the environment in which it's used, the type of work for which it's used, and the intensity with which it's used. And not every asset is going to last as long as its assigned class, and some might last even longer. An example of this is that economists have tried to estimate the depreciation rates for transportation equipment that's used in research and development. In 2006, an estimate for that depreciation rate was about 17%, but a more recent estimate placed it at least 56%. And that more recent estimate in the study noted, with such wildly differing estimates of devaluation rates, basing entire aspects of our tax system on economic depreciation can be incredibly arbitrary. So going back to those two different approaches, the change in net worth versus the cash flow approach, even if you think we should be trying to tax businesses on their change in net worth, this shows that it's very scientifically difficult to accurately determine what a change in net worth is, because it can vary on so many factors across assets. The second table on the slide here shows that our current cost recovery system does permit 100% bonus depreciation deductions, so full expensing, for investments in assets with useful lives of 20 years or less. But that provision is temporary, and it's going to start phasing out after the end of next year. And assets that don't qualify for that treatment face much harsher and longer cost recovery periods, meaning businesses are not able to fully recognize their costs on their tax returns. Another element that's not on the slide here, but it's very important to know, is that the tax treatment of expenses for research and development now also must be amortized over 5 years. From 1954 up until last year, they could be immediately deducted, but due to a change in the Tax Cuts and Jobs Act, they're now required to be amortized over 5 years, which is going to raise the cost of making R&D investments, discourage R&D, and reduce economic output. So the big takeaway here is that by preventing full capital cost recovery, the US tax system, as it stands right now, raises effective tax rates, often in arbitrary ways across industries and within industries, and that discourages domestic investment. So we can go to the next slide. While one measure of looking at corporate taxes is the statutory corporate tax rate, another way to evaluate corporate taxes is looking at effective tax rates, which take into account the statutory rate and structural aspects of the code, like those depreciation deductions we just talked about. And the two different ones that are typically used are the marginal effective tax rate and the average effective tax rate. The first looks at an investment that's going to break even, and then the second looks at an investment that earns more than enough to break even. And the calculations here on the chart that are shown assume that the slated expiration of that 100% bonus depreciation completely phases out and takes effect. And it also assumes that R&D amortization remains in effect. And so we see that the US has relatively high effective rates compared to OECD averages, and that's driven by having less generous depreciation deductions than in other OECD countries. And what that indicates is that in terms of the investment incentives created by the US tax code, that the US tax code is relatively more distortive or less efficient because it discourages investment to a greater extent than the OECD on average. We can go to the next slide. And so what does this mean for everyday people? While corporate income taxes are legally paid by corporations, the economic burden of the corporate income tax falls elsewhere in the economy. And it's not just burdening the owners or shareholders of the corporation. Several different types of studies and models support the idea that workers bear a large portion of the corporate income tax in the form of lower wages. The estimates can vary in magnitude, but most studies indicate that labor or workers bear 50% to 100% of the corporate income tax. And that's because labor is less mobile than capital. So in response to a corporate tax change, it's easier for businesses to say, I'm going to make my next investment elsewhere, than it is for workers to move in response to a corporate tax. So that means workers are left holding the bag. A recent study of this looked at tax rates in German municipalities over a 20-year period and found that workers bore about half the burden of the corporate income tax, and that low-skilled, young, and female employees bore an even larger share of the burden, implying that workers on the margin are affected more by the corporate tax. Our model reflects this current thinking, and so when we model a corporate tax change, we assume that half of the burden is ultimately borne by workers due to the effects on investment, productivity, and wages. Another way that workers can bear the burden of the corporate tax is if they own corporate stock, whether directly or indirectly through pensions and other retirement accounts. Their savings can be harmed by the corporate tax. That's because a higher corporate tax rate lowers the present value of future expected after-tax cash flows from corporations, or in other words, it reduces equity values. So ownership levels can vary among households, and we know that stock ownership is tilted toward higher income households, but holdings are owned across each income level. For example, families that earn $35,000 to a little over $50,000 among that group, about 44% own stock, so they will be impacted by a corporate tax change. Now, beyond workers, some economists have also found that consumers could be impacted by corporate tax changes. And in those studies, they've found that the effects on prices are strongest for products that are most likely to be purchased by lower income households. So across all of these studies that show that it's not just shareholders, but workers and even consumers bear the burden of the corporate income tax, that indicates that the corporate tax is less progressive than many assume because it can fall on lower and middle income households. We can go to the next slide. And then finally, another big question that we sometimes get about the corporate tax is, what about corporations without tax liability? Each year we see studies grab headlines because they'll identify dozens of big companies that reported profits on their financial statements while paying little or no tax liability to the IRS. That might seem shocking, but the reality is a lot more mundane. Taxable profits or losses are determined by tax laws, while book profits or losses are determined by accounting standards. So really, we're talking about apples and oranges, two completely different systems that have really good reasons for having different rules. So the Financial Accounting Standards Board, or FASB, sets the rules and guidelines for book income that's supposed to be used for investors to evaluate different firms. And firms have quite a bit of leeway in how they present their financials to investors. Taxable income, on the other hand, is the amount of income a company will report on its tax return. And those rules have been determined by Congress both to raise revenue and to encourage or penalize different behaviors. And firms have a lot less leeway in what they report on their tax returns. One of the biggest rule differences between book income and taxable income is depreciation. So as we just talked about depreciation deductions, the tax code allows for accelerated depreciation. And that's going to be one of the biggest drivers between gaps between book and taxable income. So in the short run, for a given investment, the tax deduction allowed is going to be much larger than the book deduction allowed because book income typically uses straight line, whereas the tax code allows 100% or other forms of accelerated depreciation. In the long run, though, that reverses. The tax deduction gets smaller than the book income deduction, which tends to remain stable. And so the difference disappears over time, and it shows that how the two are calculated isn't necessarily right and wrong. They just exist for different purposes. Of course, the purpose of accelerated depreciation in the tax code is to make sure firms get full cost recovery that reflects inflation and the time value of money or the opportunity costs of making those investments. While the rules for book income are designed to match expenses with the revenue that the investment is supposed to earn over time to create a smoother picture for investors. Even though that doesn't line up with reality, the money was spent in year one, it creates a picture of stability on financial income statements. So the gap isn't nefarious, it's just a difference in the design of the rules and the purpose of the rules. Another really big driver of book tax gaps are deductions for net operating losses. So if some corporations paid zero or a lower corporate tax bill in a certain year because they were carrying forward past losses, that should be seen as a normal feature of the tax code, and it's not really a cause for concern. Under current law, tax losses can be carried forward 20 years with some limitations, and those rules were changed a little bit during the recent downturn to allow some carrybacks as well. The importance of NOLs is this: a corporation's profit cycle doesn't necessarily really neatly line up with a calendar or a tax year. So we can imagine a company that has $50 of losses in January, and then later in July has $100 of income. I think we'd all agree that the company only made $50 that year, and their book and taxable income measures would be equivalent. But what if we shift the timing just a little bit? Let's say that the firm lost $50 in July, and then they didn't make their $100 until the next January. In year one, the company wouldn't be taxed because they had a $50 loss. But in year two, they would be taxed on the full $100. A net operating loss allows them to carry forward their $50 loss in year one to reduce their income in year two. So then the tax liability would be the same as our first example. NOLs allow firms to smooth their taxable income over time to better reflect their actual economic profits, or their revenues minus their costs. And this is another example of something that would smooth out over time in terms of the gap between book and taxable income. Most of the one-year snapshots that we see that make headlines are a result of timing differences like this. And so if you would look at a longer time horizon, most of those differences would disappear. And that's why, for the most part, those studies that find corporations don't pay taxes in a given year aren't really a big concern. They're just simply reflecting two different systems, the tax system and the financial reporting system. And with that, I'll turn it back over to Garrett.
Thanks, Erica. With that context in mind on the corporate tax space, we did want to run through 3 different examples of various tax proposals that have been considered by Congress, have been introduced by the president, to take a look at the effects that they would have on federal revenue, on economic growth, and on the distribution of incomes. And the results that I'll be going through here come from the Tax Foundation's modeling of these tax impacts using our economic model. And so the first I wanted to go through is a proposed increase in the corporate tax rate from 21% up to 28%. This featured, of course, in the president's his campaign in 2020 and in the budget discussions in both last year's budget and the budget that was proposed just about a week ago to raise that rate to 28%. And as we discussed earlier, we tend to find that using our modeling, and many other economists also find, that this would tend to be a drag on economic output. And we've quantified that here, as you can see on the left-hand side of this slide, that long-run economic output as measured by GDP would be reduced by about 0.7% in the long run. It would also reduce the overall capital stock by about 1.4%, while also reducing American incomes as measured by gross national product by 0.7% as well. It would also result in a reduction in jobs by about 138,000. And the reason why the capital stock and investment tends to go down under this is because the tax increase would raise the cost of future investment, the cost of capital. And that means there's going to be fewer investments and economic output will be lower, and there's going to be lower real wages when workers are less productive as a result of that less investment. We also find that it would raise revenue about $886 billion over 10 years on a conventional basis, meaning holding the economy size constant. Though this revenue is accounting for the partial offset that we would get, because we would expect increased profit shifting by corporations due to the higher rate. There's going to be an increased incentive when you have a higher rate like this to shift profits overseas, something that my colleague Daniel will get into in a little more detail in a little bit. And then on a dynamic basis, we would raise about $693 billion over 10 years, round up to $694 billion. And that accounts for reduced economic output, which would tend to also reduce individual and payroll tax revenue as a result of this corporate tax hike. Before getting into the distributional information, another important point here is that this would once again return the U.S. to near the top of the statutory tax rate rankings in the OECD, going against the trend, which is continuing to reduce tax rates into typically the low 20s as the OECD average. We can also see here on the right, distributionally, that raising the corporate tax rate to 28% would reduce after-tax incomes across all income levels. And that's because of the effects that Erica just walked through in terms of lower after-tax wages for workers at corporations and lower values of corporate equities because of the higher rate, many of which are owned by middle-class individuals and households who are looking to retire or have other taxable investments, including through pension funds, which are owned by many working class and middle-class households as well. And so you do see that across the board reduction, though it is a little bit higher of a reduction near the top, and that's because corporate equities are owned near the top in greater proportions as well. So to move to the next slide, I also wanted to chat a little bit about the proposal to tax the book income of corporations. So this is a proposal directly to deal with the issue that Erica just walked through here earlier, which is differences between taxable and book income for corporations. And so as Erica explained, there are differences in the accounting standards and tax laws governing corporations, which means they may have different taxable financial incomes. And so the slide here actually just goes through a quantitative example of the differences in how taxable income and book income treat depreciation, as Erica had walked through, providing, in this case, a corporation with $100 million in revenue and a $30 million investment. Under the tax law, in this case, they may be able to fully deduct the cost of the short-lived investment. But under book income standards, they must depreciate the asset over its useful life, in this case, 5 years. And that generates, over the course of these 5 years, differences between the amount of income that's taxable and the amount of book income. And you'll notice that it actually flips. In year 1, book income is greater than taxable income. In year 5, it's actually the reverse, as the firm is still deducting the cost of their asset on their books, but they already took a full and immediate deduction on their taxes. And so there are proposals here to levy a minimum tax on corporate book income. The president proposed a 15% minimum tax, while others like Senator Warren proposed a real corporate profits tax that would also partially reduce the differences between book and taxable income. And there's a few different things to emphasize here in terms of effects. One is imposing a minimum tax like this would, to some extent, effectively hand over the determination of part of the tax base to FASB, which is the nonprofit body that is certified by the SEC to make decisions about what are generally accepted accounting rules. And that possibility is concerning because really should be the domain of elected officials and Congress to determine what is in the tax base. And on the flip side, it would also insert FASB into tax disputes that are usually more appropriate for elected officials, regulatory guidance, and the tax courts. The other risk of this type of proposal is by mixing up these two definitions of income, it may make financial income less valuable to corporate shareholders and investors and other stakeholders who rely on it. And that's because when you start taxing the book income of corporations, there's going to be an incentive to change that book income because of that tax. And generally speaking, book income, there actually is some flexibility for corporations to determine how it is measured and how it is accounted for. And that's going to be a pretty big concern if we consider financial information to be valuable for those shareholders and prospective investors as well. Finally, there's also going to be a concern that this tax would have implications for tax credits provided in the tax code that tend to also reduce tax liability, but don't reduce book income. For example, the R&D tax credit, green energy credits. The president's proposal to impose this minimum tax would carve out or exempt many of those credits from this tax, but that actually undermines the very purpose of the tax, which is to reduce these gaps between taxable income and book income. And so it's almost a self-defeating thing if you are exempting the very credits that are driving these gaps in the first place. And finally, the economic effect of this tax would depend on whether the tax is assessed on minimum income, like the Biden proposal, or if it's a tax on top of the existing system, like Senator Warren's proposal during the primaries. In the case of a minimum tax, firms would tend to enter in and out of this tax over time, which would produce investment incentives that may be greater or less than the current corporate tax. Though it's worth noting that this would still produce distortions in investment incentives relative to current law and to a neutral tax system that is more simple to deal with. Moving on to the final slide on policy implications here, I did want to highlight the proposal that Erica mentioned to cancel R&D amortization. As Erica walked through, starting in 2022, corporations and pass-through firms must amortize R&D over 5 years, up to 15 years for certain types of R&D investment. And that differs from the treatment that prevailed before 2022, which was a full and immediate deduction for those expenses, which really is the standard treatment, both across the OECD and historically. As Erica had mentioned, we have had a record of allowing for full and immediate expensing R&D going back to 1954. And this will be a headwind to economic growth and technological innovation, possibly, especially in an age where we're trying to compete with other emerging powers and preserve the R&D capacity of the United States. And so just as it's important to preserve full and immediate cost recovery for capital investment overall, that is also true of R&D investment. And we find that if we were to cancel R&D amortization, the long run economy would increase by about 0.1%. And it would increase after-tax incomes across the board. And of course, this is a conservative estimate because there may be benefits over and above this benefit to consumers and Americans overall by bringing more R&D into the U.S. It's also worth noting that about 75% of the long-run cost, or the cost over the 10-year budget window, I should say, is in the first 4 years. And that's because there's a steady state cost that's much smaller once existing investment cycles through this change. The long run cost is actually about $5 billion over 10 years, in the $5 to $6 billion per year in the second half of that budget window over 10 years. And so when you account for the increased economic growth, that's actually a pretty good deal. But it does mean over the first 10 years is about $108 billion cost when you account for the increased growth in the economy. So with that, all those three proposals in mind, I did want to turn it over to my colleague Daniel Bunn to chat a little bit about our international tax system.
Thanks so much, Garrett, and thanks to Erica as well. I think this has been a great overview so far. So we're going to shift gears a little bit, and we're going to think globally. Think about multinationals and how they are taxed. A U.S. corporation that has earnings abroad gets to deal with a lot more rules than a U.S. corporation that just does business domestically. You might have your headquarters in Illinois. You might have manufacturing in Germany or Southeast Asia, and then you might have customers in hundreds of countries around the world or jurisdictions around the world. And the rules that the US tax system used to have essentially created a border between the US, a tax border between the US and foreign jurisdictions, where if you earned your profits abroad, it made it expensive to bring those profits back home and reinvest them in the US. In fact, more than $2 trillion of US profits were held offshore prior to the 2017 tax reform, specifically to avoid having to pay the high US corporate rate upon reentry. Now, the reform in 2017 brought in a lower corporate rate, and it changed our approach generally to foreign profits, made it a little bit easier for profits to come back home without an additional charge. But these three policies on the screen right now, GILTI, BEAT, and FDII, they changed the incentives for companies when thinking about tax planning. Now, one of the things a multinational has at its disposal that a domestic company does not is the ability to think about, okay, well, if I want to sell products in Europe, do I set up shop in France? Do I set up shop in Italy, or do I use Ireland? Ireland has a low corporate tax rate of 12.5%. And a lot of US companies, when looking to sell in Europe, have set up operations in Ireland to benefit from the low corporate tax rate. Additionally, companies may look at places like the Cayman Islands or Bermuda and say, well, we want some of our profits to be earned there in very low tax jurisdictions. And a lot of times these end up being somewhat artificial arrangements, but they lower the overall tax burden for companies and leave room for investment elsewhere or investment at home. However, the amount of activity that might be recorded in Bermuda or the Caymans creates a risk for some governments. So the US, in looking at tax reform, wanted to bring down the overall corporate tax rate, but lawmakers also wanted to protect a little bit against the incentives for companies to set up offices or put profits in low tax jurisdictions just for the sake of putting profits there, not that there was, manufacturing going on in some of those jurisdictions. So they brought in this policy called the Global Intangible Low Tax Income, and that applies a minimum rate to the foreign earnings of US companies. It's a 50% rate of, 50% of the statutory rate, so 10.5%, but that's not the end of it. There are interactions between GILTI and our foreign tax credit rules that for a lot of companies, you're paying much more than 10.5%, especially if you have exposure to higher tax jurisdictions abroad. That rate is scheduled to go up to 13.125% in 2026 under current law. And in Build Back Better, there was a proposal from to move the rate to 15% and to change the calculation from kind of a global average to a calculation on a country by country basis to really kind of tighten the gears in ways that I think would raise both compliance costs significantly and raise the tax costs for doing business abroad. Secondly, lawmakers in 2017 brought in something called the BEAT, the Base Erosion Anti-Abuse Tax, and the BEAT applies a minimum rate to a different definition of profits for companies that have a lot of cross-border transactions. So one way that companies might do their tax planning and reduce the amount of tax payments they pay to the US is by having a lot of deductions in the US and those payments be income elsewhere in the world, maybe at a lower tax rate. In theory, the BEAT was to come in and help keep some of the tax revenue for the US government rather than allowing these cross-border schemes to proliferate. However, there were some problems with just as there were problems with GILTI and our foreign tax credit rules, there were problems with BEAT and some of our domestic tax incentives. Lawmakers in Build Back Better were also looking at BEAT for some adjustments. Current law rate on BEAT is 10%. That's scheduled to go up to 12.5% by 2026. But lawmakers in Build Back Better were looking at an 18% rate by 2024 on BEAT. And the president's most recent budget also has a completely different approach to this, which I'll get to in a moment. The third piece of this puzzle, think about a company that has intellectual property, a company that has a patent or a piece of software that honestly they could choose to put anywhere in the world at relatively low cost of moving things around. Like it's really moving, a license agreement to a different jurisdiction. And the US looked at this ability of companies to move IP abroad and the way that other countries create lower tax rates for IP profits and brought in the foreign derived intangible income, FDII, to apply a lower rate for US companies that keep their IP in the US and export abroad. The rate on FDII is 13.125, and this is designed to balance between FDII, domestic incentives for where you put your IP, and GILTI, for incentives on where you put your profits in foreign jurisdictions, and meant to create a rough balance between the two so that US companies didn't really see an extra benefit to, hey, we created this software in the US, now we're going to move it somewhere else for tax purposes. And in fact, a lot of companies have brought their IP back to the US from offshore after tax reform, partially because of the incentive of FDII. Now, if we can move to the next slide, we're going to get into kind of a really big, important conversation that's been happening for a few years. After the US adopted GILTI, BEAT, and FDII, especially GILTI, a lot of other countries looked at that and said, a minimum tax on foreign profits, that looks interesting. I wonder if we could agree globally on a system that would allow for a global minimum tax. And then some other countries looked at this and they said, hey, we also want to change where companies pay taxes if a company does not have a local physical presence, but has a lot of sales. Think of a tech company that might have actual operations and programmers in a handful of countries, but essentially their products are available anywhere there's internet. And lawmakers and policymakers across the world were trying to figure out a way to rearrange the system so that some share of corporate profits were taxed in the location of the consumer. Now, this is all extremely complicated, but I've tried to boil it down to a relatively simple table here because this is kind of the basic way this would work. So this is part of the global tax deal that has been in the news over the last couple of years. The most recent agreement was in October. There are model rules that are being rolled out. There are consultation papers and things like that. Pillar 1 of this global tax deal changes where companies might pay their taxes. So for instance, in this example, you have a company with 40 billion in annual revenues. profits of 10 billion. So there's 30 billion in costs there. That's a profit margin, that 10 billion, a profit margin of 25%. Pillar 1 says that the only profits that are affected are those profits above a 10% margin. So your total profits of 10 billion, the profits above a 10% margin, so in excess of 4 billion, is $6 billion, and 25% of those profits that are above the 10% margin might be reallocated. So for this company, 1.5 billion of their profits might be taxed in different locations than they would otherwise. Let's assume this company only exists in the US and has 100% exports. So that 1.5 billion that would be taxed in the US, that will now be taxed based on where the consumers reside. Now, some of those consumers are in the US, so the US would get its share. But then those consumers that reside outside of the US would have a lower amount of tax revenue from that company. On pillar 2, if we could go to the next slide, this is the global minimum tax. The global minimum tax of 15% will apply on the largest kind of multinational businesses. This is roughly inspired by GILTI, but it is calculated very differently from GILTI. Again, we've got a company with 40 billion in annual revenues, profits of 10 billion, and faces, let's say this company's in a low tax jurisdiction, has a 10% effective tax rate. The top up rate would be 5%. So if a company is paying 10%, the global minimum tax would say, okay, we're going to enforce the rules on this company and make them pay an additional 5%. So again, the normal tax liability for this company at a 10% rate would be 1 billion. The top-up tax would be 0.5%. I'm sorry, 0.5, and then you would have full after-tax profits of 8.5, so 10 minus 1.5 combined. Now, I think one of the big things going forward is going to be the questions that I have about enforcing and adopting all of these things. There were pieces of this in Build Back Better. We're not sure, where that moves forward. And now there's pieces of this in the president's budget. And there are conversations in the EU, the UK, Japan, Switzerland, Singapore, all about how this is all going to come to fruition and be enforced. And I think right now it's really important for policymakers to be able to go beyond these simple tables and understand the details and how they'll affect companies kind of worldwide, and how they're changed the decision for companies on where they're investing and where they're hiring and things like that going forward. And with that, I think our next slide is the question slide. There we go. Back to you, Tyler.
Yeah, thanks, Daniel. That was a great overview. That was a lot to run through in 45 minutes, but I think we did a fantastic job. So just as a reminder, please submit your questions via the QA function at the bottom of your screen. So really, I think the first question is a good one to start off with. So a viewer asks, isn't it accurate to say that corporations don't really pay taxes, consumers do? So the question kind of leads into what would happen if corporations paid no income tax, or somehow we allocated profits to shareholders and consumers? How would that work? And is that a system that has been tried elsewhere in the world? I see Garrett is chomping at the bit. So Garrett, I'll hand it off to you to answer that question. But yeah, Garrett, is there a system like this where corporations don't pay taxes, but yet that tax rights are allocated elsewhere?
Sure. Yes, I think there are two things here. One is it's fair to say that corporations ultimately, when they are taxed, that the corporations don't exist independent of individuals. So ultimately, some individuals bear the cost of that tax. And in the context of the corporate tax, it's going to be some mix of shareholders, of workers, in the case of folks working there. So it's a split between, if you will, capital in the form of shareholders owning that corporation, or workers in the form of labor there. So there's some split between who bears the burden of that tax. And as we had mentioned earlier, of course, the shareholders here may be everyday folks, right? It's not just people at the very top who own corporate equities in the United States. And of course, people earn money to ultimately spend it. So of course, consumers, when you think about your after-tax sort of income that you have available for you to spend, you're going to be impacted there as well. And then to get to the second part of this question, which I think is, wouldn't it be smart if we didn't pay any income tax? As I mentioned at the beginning, under the US system, and is common in many tax systems, there's a tax at the firm level, and then that corporate income is taxed again at the individual level based on dividends that are distributed and capital gains on corporate equity when that equity is realized. And so there is basically two sets of taxes here that actually increase the total tax burden on corporate income. There are proposals out there and countries that have actually done this to integrate these two taxes together so that there's only one total tax on corporate income. It's known as a fancy word known as corporate integration. And a few different countries have done this. Two that I would point to that might be helpful in the US context are Estonia, which has taken one approach of trying to exempt some of the dividends that are paid out to ensure, with some other details, to ensure that there's only one level of tax. Another example of a country that's tried to do this is Australia, who tries to use tax credits in a clever way to ensure there's only one layer of tax on corporations. And the one advantage of this, of course, is that it helps to ensure that there's sort of a level playing field between corporations and pass-through entities that I had mentioned at the beginning. So yeah, lots of interesting international examples we could use when we think about corporate tax reform at home.
Great, thanks, Garrett. That was a really good overview. So I guess let's talk a little bit about the global tax deal. Daniel, I don't know if you could expand a little bit more on how is this going to impact American, first of all, the Treasury Department, and then second of all, American businesses investing both here and abroad?
That's a great question, Tyler. I'm going to work with, let's assume that everything goes according to the OECD's plan and everything becomes law at some point in the future. Let's assume that happens. It's probably a long road to get there, but let's work from that assumption. So under that scenario, the impact on the U.S. Treasury will be one where some U.S. companies will be paying less to the U.S. government. Some foreign companies will be paying a little bit more. I'm of the opinion that we're going to, on net, lose revenue under Pillar 1, this reallocation of where companies pay taxes. But that kind of relies on some rules that haven't yet been finalized yet. I still think we're going to be a net revenue loser under Pillar 1. I'll be willing to say I was wrong if the rules end up being negotiated differently. So that's one piece. On the global minimum tax, the impact on business investment decisions is pretty critical. The difference between the financial accounting and the tax accounting that Erica so eloquently described is going to be right in the front and center of this global minimum tax, because the global minimum tax relies on financial accounting. And whereas a company might have made an investment decision in one way in prior years based on tax accounting and saying, okay, we get full expensing and we get tax credits and we get all these other things, the global minimum tax is going to change some of that thinking. So companies are going to be able to be a little bit more wary and saying, okay, if we're going to take this huge deduction and we're also going to get this tax credit, are we going to put ourselves at risk of getting a top-up tax under the minimum tax? And therefore, the effective tax rate on that next investment is significantly different than it might have been previously. Now, this is mostly going to be impacting companies that benefit from things like FDII. Like they have their IP in the US, that IP is taxed at a lower rate, a rate below the 15% rate for the global minimum tax. They might be doing a lot of capital investment in the US, so they have a lot of deductions there as well. And then they might benefit from things like green energy credits or credits for low-income housing if they're investing in housing projects, or if they're doing R&D, the R&D tax credit, or there's all sorts of tax credits in the US tax code. I can't go through the whole list, but all of those things combined with the global minimum tax will change the calculus for, okay, what's the effective tax rate on my investment? And it will change which incentives or policies are valuable to companies. And it also changed the location. So if you were investing in, let's say Bulgaria's got, I think, a 9% corporate tax rate. If you were investing a lot in Bulgaria, or Hungary's got a 9% rate as well, just because of their low rate, then you may not be as attracted to locate an investment in those countries. Maybe you move to a country that's right at the 15 to 20% range, so you're less exposed to the global minimum tax.
Awesome. That was a great succinct overview of a very complicated issue. So thanks, Daniel. Erica, I have a question for you. When you look at marginal effective tax rates and average effective tax rates as an economist, I know you explained a little bit of it, but what do those mean to somebody like me who's not a tax expert? Why should I care about those? And what are some of the differences in how you think about those two numbers?
Yeah, that's a good question. So when we're thinking about those, we can kind of think about the tax wedge that's created between the pre-tax return that an investment is going to make and the after-tax return that an investment is going to make. So we know that for an investment to be viable, a business is going to have to get enough back in terms of the revenue that that investment generates to cover their tax bill, to cover the economic depreciation or the wearing out of that asset, and to cover the return that their investors are demanding. So if the tax rate or the tax base changes to increase taxes on corporations, that means that the cost of making an investment is going to go up, or they're going to have a higher pre-tax return in order to be able to meet all of those requirements for the investment to be worthwhile to them. And so when we're looking at measures of the marginal effective or average effective tax rate, that's telling us just how big the tax wedge is between that pre-tax rate of return that's required and the after-tax rate of return that they'll get once we see the tax burden. So when that tax wedge goes up, that means fewer investments are now viable because the tax cost means so many more investments won't be worth it given that higher tax cost. So that's one way to think about what those rates actually mean.
Awesome. Thank you for that. Erica, Gary, I don't know who wants to take this question, but how much money do we actually get from the corporate tax code? How significant of a revenue raiser is that for the federal government? What are some of the trends we've seen? Because obviously 2020 was not exactly the best year for a lot of businesses, and then we saw a significant turnaround in 21. So what are some of the trends of the corporate tax code of how much money it's raised? And is it a really significant tax revenue raiser for the federal government? Erica, you can go first.
Yeah, okay. So one thing on trends, well, for actual 2020 revenue, the corporate tax raised a little bit over 200 billion. If you compare that to individual income tax revenues, it was about 1.6 trillion. So the corporate tax raises a relatively small amount of revenue compared to other broader taxes like payroll taxes and individual income taxes. One thing that we often see when we're talking about the corporate tax and how much it raises in the United States is comparisons to other OECD countries as a share of GDP. But because the United States is so unique and that many more of our businesses are arranged as pass-through entities, so they are like partnerships or LLCs, their income is reported and taxed on individual income tax returns as opposed to corporate tax returns. Making a comparison of our corporate tax receipts as a share of GDP to other countries' corporate tax receipts as a share of GDP is kind of like apples and oranges because so much of our business activity in the US happens on the pass-through side. So if we look at adjustments, if we adjust for the size of the corporate sector or the size of the pass-through sector, we're really about on par with OECD countries in terms of how much revenue we get from the corporate sector when we make those necessary adjustments. I don't know, Garrett, if you have anything to add to trends in terms of that.
Yeah, I think it's a good overview about situating the corporate tax in context. We did find, of course, in 2021, corporate tax revenue did rebound quite nicely from the pandemic. It hit an all-time high in 2021, and we have met or even slightly exceeded the pre-TCJA revenue estimates from Congressional Budget Office and the Office of Management and Budget, which shows general revenue growth, and that's shared, of course, across when you look at the individual income tax and other sources of revenue. State revenue sources are up. So overall, I mean, we're in a fairly healthy place, even with the TCJA changes on revenue, and it's really outperformed expectations in the past. And we'll just have to see how much that holds, given where profits go in the future. Having a healthy corporate environment helps a lot, of course, to keep profits up. And based on even what the Treasury Department has released for their revenue estimates for raising the corporate tax up and changing international taxes, they're also expecting a pretty healthy corporate environment moving forward for revenue, which no matter where you are in that debate is probably good news all around.
Awesome. Thank you both for that. So we have about 2 minutes left here. And I wanted to touch on something I think related to expensing. So Erica, when you were talking about makers, you mentioned that it's going to wind down. So what are some of the economic impacts of that happening? I know that expensing is obviously the right way to treat investment, but I was curious if you had any numbers on the impact on investment, and what happens if Congress allows that to happen.
Yeah, so investment incentives will get worse essentially if bonus depreciation phases out. Bonus depreciation 100% was temporarily put in place by the 2017 Tax Cuts and Jobs Act, which also lowered our corporate rate from 35% to 21%. If bonus depreciation had been permanent as a feature of TCJA, it would have been a more powerful pro-growth provision than reducing the corporate tax rate. The reason it's so powerful, even compared to a corporate rate reduction, is because the benefits of expensing are entirely aimed at new investments. So in order to get the deduction, you have to make a new domestic investment. It's targeted entirely at those investment incentives. Allowing it to phase out, of course, will reduce incentives to invest in the United States because firms will have to depreciate those investments over time, and it increases the cost of doing so. We have estimated that making it permanent, so instead of letting it phase out, making it permanent at that 100% level would increase GDP by about 0.5% in the long run and create more than 80,000 full-time equivalent jobs, raise wages by about 0.4% because of all of the investments that would be undertaken under 100% bonus depreciation. That boosts worker productivity, which boosts wages and creates job opportunities. So really, it's one of the best options within the tax system that lawmakers have to promote domestic investment if they make it permanent.
Awesome. Thanks for that, Erica. Well, I want to thank all three of our experts for answering my questions and the audience questions and their presentations. As I mentioned earlier, the recording and their slides will be available publicly on our website on the landing page. So I will send that out to all the registrants Friday or tomorrow in an email. And I encourage you, if you have specific questions, please reach out to our experts. Their contact information is on the slides and also on our website. So please feel free to reach out to them if you have any questions. Our next TFU session will be next Thursday, same exact time, noon Eastern time. Garrett and Erica will be covering the individual income tax code. Thank you for joining us this afternoon, and we look forward to hosting you next week. Take care.